Hey, what's going on, guys? It's Nick here from Ways of Wealth. It's week 26 of the market recap. And if this is your first time here, we highlight key events that happened in the market over the past week. So if you learned something new, I'm going to ask you a favor. Please give me a thumbs up and make sure to subscribe. We do this every single week. On this week's episode, we have a great one lined up. We're going to be talking about not only Fortune 500 companies, but small businesses alike. They're not seeing eye to eye with Facebook's new policies, and they've enacted a boycott. We're also going to be talking about, this past week and the rocky ride that the stock market went on. Is this an indication of what's to come? Stay tuned for more. All right, let's dive in. Facebook is in hot water again, as many advertisers have started pulling their ads from the social media platform. This is due to companies protesting against Zuckerberg and Facebook's misinformation and hate speech policies. Unilever was one of the first companies to announce that it would be pulling its ads from the social media platform this week. This mother company is host to several household brands that I'm sure you're familiar with. Dove, Lipton, and Axe, just to name a few. On an annualized basis, Unilever spent about $42 million in change on ads with Facebook. We've also seen other companies like Verizon, Levi's, Patagonia, Honda, and as of most recent, Coca-Cola announced on Friday that they would be joining the boycott. Coca-Cola announced that it would take the next 30 days to reassess its social media plan and which partners it wants to work with moving forward. James Quincy, who is the chief executive officer of Coca-Cola, stated about Facebook that he does expect better transparency, action, and accountability from the social media platform. And it doesn't end with the Fortune 500-esque companies. Small businesses are also following suit, and they make up a majority of Facebook's 8 million ad clients. In 2019, Facebook's ad revenue accounted for $69 billion in revenue. This stream of income is definitely the lion's share for the company and will definitely hurt in the coming earnings reports. The company does have another revenue generator in its Portal and Oculus hardware business, which recently grew 80% year over year to $297 million, but it's nowhere close to the ad revenue. When addressing the public on Friday, Zuckerberg did announce that Facebook would now label all voting related posts, not only Trump's, but all the like. From there, they would also ban hateful ads. But what people were looking for was for him to address the boycott issue head on. He neglected to do so. So it'll be interesting to see how Facebook can bounce back from this situation. I know that Instagram and Facebook, those platforms, are huge for reaching to people. I know for myself, I enjoy both of them, probably more along the lines of Instagram. But it'll be interesting to see what actions and things that they do moving forward in order to, allow companies to feel comfortable using them as a source of, ad space or putting their ad plans to use. Now on to the next topic of more trouble ahead. Not only are we seeing the number of COVID cases continue to spike in the southern US states, that is not the only concern that I have moving forward, although some may say that we are testing too much. One of the things that I definitely think moving forward, I don't think that the government imposes a lockdown. I think that some Fortune 500 companies or other companies will lock down locations like we've seen with Apple in the Houston market to kind of uphold that corporate social responsibility. But it's what does life look like after, and what happens after that monetary policy or quantitative easing ceases. My fear is that the bubble in the stock market is higher than it was in February of this past year. We have discussed many times before, but there are a few names that are carrying the index since the March 23rd low. Facebook, Amazon, Microsoft, and Google are up 23% year to date. Investing legend Bob Farrell, who spent 45 years on Wall Street, has a list of 10 rules of investing. Most importantly, in this scenario, rule number 7. Markets are the strongest when they are broad and weakest when they narrow down to a handful of blue chip names. And this is evident now more than ever. It has become ever more apparent that the stock market rally is synonymous with the Federal Reserve's quantitative easing. Larry Berman shared a chart highlighting the markets are no longer fundamentally driven, instead driven by liquidity. The orange line highlights the S&P 500 index, and the white line indicates the expansion of the Fed's balance sheet. The S&P starts climbing towards the end of March as the Fed starts providing more liquidity into the markets. For the past 2 weeks, we see that the Fed has not allowed for any further increase in the balance sheet, which is then reflected in the S&P's sideways move, or what the CNBC is calling the kangaroo market. It has been great that the Federal Reserve has been able to act so quickly, putting money and quantitative easing into the market much faster than they did in the 08-09 Great Recession. But to be honest with you, it's a band-aid solution. My biggest fear moving forward is demand, consumer demand, how much people are willing to spend and go out kind of in the months to come. But not only is demand one of my biggest, concerns moving forward, here's a list of some other concerns that are, troubling economists across the nation. Aging demographics due to a low fertility rate. People aren't having babies like they used to, and without the population growth, the economy is not going to grow in turn. The mass quantitative easing measures have created large amounts of debt that will eventually have to be paid back, whether that's through taxation or a wealth tax. This race to the bottom in regards to companies trying to provide the lowest price has caused a shift in supply chains to continents with low labor and production costs. This has essentially eliminated US production and therefore kills exports and industrial production. One article I read stated that the Federal Reserve will never be able to raise interest rates or eliminate monetary policy ever again. And that's all this week for the market recap. Thank you for tuning in. I appreciate your support. Make sure if you learned something new, give me a thumbs up, helps the channel grow. If you haven't already, please subscribe. We do this every single week. Thank you again for tuning in. I look forward to seeing you guys next week. Have a great week on the markets. Happy trading.